Remember when everybody said 2024 is going to be a great year to buy a house because mortgage rates are going to go down? I may have been one of those people. Thought maybe mortgage rates be in the mid sixes by spring, maybe the upper fives by the end of the year. Y'all, it's not working out that way. Middle of April, rates are back up in the mid sevens. What in the heck is going on? And when's it going to change? Buckle up. What's going on? This is Steve, real estate agent with the Malone Home Team EXP here in the Atlanta area. So first things first, like and subscribe, pretty please, if you wouldn't mind. Assuming they would do a good job. If we do a terrible job, then just don't do anything because I don't want you to ruin it. But any liking or subscribing just helps us get seen more in the algorithm, get our stuff out there because we've got a lot to talk about. Today we're talking about the thing that everybody's talking about, the mortgage rates. Okay, mortgage rates coming into this year. Everybody had the opinion that they'd fall through the sixes very slowly through the year, maybe end up in the upper fives by the end of the year. Somewhere on that path, we kind of took a hard right, and it did not end up where we thought it was going to be. The interest rates as of this moment, mid-April, this could change a whole lot in the next week, so this video may be just out the window in a couple days. But as of this moment, I should say, interest rates are in the mid-sevens. We had some very hot reports coming out. Unemployment, inflation, consumer spending. All not where they're supposed to be if you want to be in a position where the mortgage rates are going down. So, in this video, what are we going to do? We are going to lay out the ideas, lay out why the rates are so high. The two levers, this is the most important thing, the two levers that we need to pull back to get those rates to come down. And that's why the rates aren't coming down. They're going up because those two levers are being pushed instead of pulled, okay? So we're going to talk about why the rates are so high, the two levers we got to hit, and we're going to wrap this up by saying that as of this moment, to me, long term, actually looking better for mortgage rates. So I think that because things are the way that they are, I think mortgage rates in the end are going to take an even bigger tumble than what we were thinking. What does that mean? That's a great question. That's why you have to stick around and watch the whole darn video, all right? So, I'm Steve. We're talking mortgage rates. It's going to be ugly. Apologize ahead of time. But we're going to make it as entertaining as possible. So, because I'm Italian, I use a lot of hand gestures. My face will make different crazy faces and everything like that. Let's break it down. Let's talk mortgage rates. What's going on? What's happening next? The reason why the mortgage rates are as high as they are is because the economy is still rolling along. Now, the Fed, the Federal Reserve, has been raising what they call the Fed funds rate. That's the rate that banks lend money to each other, okay? They've been raising that and raising that and raising that over the last couple of years in an attempt to slow the economy down. If the economy slows down, mortgage rates are going to come down. So the mortgage rates are not necessarily connected to the Fed funds rate, but they kind of run in parallel. They're not directly connected, but they run in parallel, okay? So Fed funds rate is high because they're trying to slow the economy down. The mortgage rates are high because the economy is doing great. We say this all the time. The economy is terrible. If you have bad economic news, that's great for mortgage rates. Like when we had the pandemic. Pandemic stunk because everybody was out of work. Nobody's spending any money. Mortgage rates came down to 2 to 3% to try and stimulate the economy. Bad economic news, great mortgage rates. Economy's doing great. Unemployment's in good shape. You're going to have mortgage rates that are high. That's where we are right now. So, what the thought was, Fed raised the rates way up, okay? And they've been holding those rates for a while, okay? In the last year, they stopped raising the rates. I don't know if they're going to raise the rates anymore because they thought to themselves, we raised it enough. They didn't want to raise it anymore. They probably raised it more than they wanted to, but they saw that the economy pulled back a little bit, and it has, okay? Now, what they thought was maybe the economy will come back into check, we'll have kind of a smooth landing, as everybody says, and everything will roll on. So there's two things that they're looking at. All right, so here's the two levers. One of them is unemployment. The other one is inflation. Unemployment. There are too many people employed. Sounds weird. But again, like we just said, economic news. Great economic news, bad for mortgage rates. A lot of people employed. The unemployment level went to 3.7 last month. It was 3.8, which is very low. It went to 3.7, which is even more very low, okay? So the feds want the feds want the unemployment rate to be somewhere closer to 5%. That's kind of a balanced employment, okay? If there's too many people employed, then a lot of jobs are competing to have people come in by overpaying. When you're overpaying, you're putting a lot more money into the system, blah, blah, blah. The economy's rolling. If more people are unemployed, the economy comes back down, everything flattens out. That was the thought process. And by the feds raising the Fed funds rate, it makes it harder for businesses to borrow money. They have to cut costs, whatever, and they have to cut people, and that's what's going to bring the employment up, all that stuff, okay? But somewhere on the way to having an employment picture that got closer to 5%, the unemployment rate is actually going down, and it's below 4. It is what it is. Now, there's a lot of people that say, oh, well, the books are cooked, and they're just lying about that, whatever. You got to call the game that's on the field, okay? I'll let everybody fight that out. I have my theories about that, too. It doesn't matter. The game's on the field. The game on the field shows that the unemployment rate is 3.7%, okay? So because of that, the feds feel like, well, shoot, there's nothing like bad economy about an unemployment rate that's 3.7%, okay? So they're not going to drop the rates, which is what they were thinking. They're not going to drop the Fed funds rate anytime soon. They're signaling that the economy is rolling. And if the economy is rolling, the mortgage rates aren't going to do anything. They're actually going to go up. And that's what they did on the heels of, again, this is mid-April right now. It was early April employment report. That was the first lever that went wrong this month. We were hoping it would be better. It was much worse. So the rates went up to about 7.1, 7.2. Then the next week we had an inflation report. The inflation report came in hotter than it was expected. Inflation's the other lever. If the inflation is going back in the other direction, inflation looks like it's cooling off, that means the economy is cooling off. That means that things aren't as crazy as they were, okay? And that's indicative of the economy cooling down. That's going to allow for mortgage rates to come down. The inflation was higher than expected. Guess what that means? That means the economy has a lot of money in it. Economy is going. Mortgage rates go up a little bit more. All right, they're at 7.25. Then on Monday, consumer spending report comes out, and consumer spending was off the charts crazy last month. Okay, here's the thing. Okay, this is like the third unseen lever, but all of a sudden this has become a lever this month because there's a crap ton more spending in March by consumers than everybody was expecting. And I've talked about this before too. I go to Costco. I got 7 kids, so we drop major dime in Costco. We got to eat, all right? I go to Costco at 9:45 on a Saturday morning, okay? They open at 9:30. 9:45 Saturday morning, Costco's full. The freaking parking lot's full 15 minutes after they open on a Saturday morning, okay? Full. I'm talking full, mother you-know-what and full in the Costco parking lot, okay? Now, that is a very small whatever, but I ask people all the time, have you changed anything about what you're doing spending money? No. Changing anything about what you're doing driving? No. Everybody's just belly aching about the fact that the gas prices are high and everything's expensive, which I do too. And gas prices stink. Costco stinks. Everything stinks price-wise, right? I love Costco. I'm just kidding about that. Costco stinks. The prices stink sometimes. But man, I love them hot dogs over at Costco. Anyway, what I'm saying is the economy is in good shape right now. It's not as crazy as it was last year, but it's still strong. Until those levers get pulled in the other direction, okay? Once you see more people become unemployed, once you then go to the inflation, and inflation slows down, and then consumer spending goes down. Once all three of those things happen, that is the indication that the economy is slowing down. Once you get the indication that the economy is slowing down, the mortgage rates are going to come back, okay? Until those three things happen, mortgage rates aren't going to do anything. They're going to hold in the upper 6s to low 7s. I think mid-7s is a little high. I think mid-7s is probably a knee-jerk reaction to some of the news. But I think it's going to settle somewhere near 7, maybe 7.1, 7.2, until you get, reports of unemployment going up, reports of inflation getting pulled back. We're going to have to wait till the beginning part of May to see what the next update is. The next update's hot again. Could we potentially see mortgage rates getting back close to 8%? I would have put good money at the beginning of this year. I would have put real good money that wasn't going to happen. I will not put that good money up anymore. Holy cow. So, those are the levers we're watching. Again, unemployment has to go up. More people have to be unemployed for the mortgage rates to come down. Okay. Number two, inflation has to get pulled back. Okay, that's indicative of a slowing economy. And number three, consumer spending's got to go down. All those three things happen, mortgage rates come down. If they don't, mortgage rates are going to go up and stay high. Okay, those are the levers that we're watching. Now, let's talk about what's going to happen next, because now what the Fed is going to do this year is different than what everybody thought they were going to do, and that's going to mean a different landing spot. So coming into this year, what everybody thought was going to happen was the Feds were going to do rate cuts. Nobody thought the Feds were going to do any rate hikes. And still at this point, looking at all the projections going forward, nobody is thinking the Feds are going to raise the rates. They are at the top, okay? The question is, how many rate drops are they going to do this year? At the beginning of the year, it looked like it might be something in the neighborhood of 4 to 6 drops this year. Which, I mean, if that had happened, we were going to see the interest rates in the fives by the end of the year. The mortgage rates, I should say, in the fives by the end of the year is going to be indicative of the fact that the economy was heading in the right direction. It was slowing down. They were trying to hit that soft landing. They didn't want a recession. They were trying to hit that soft landing, bring everything back. Economy just kind of teeters to like a midpoint. Everything goes great. I think that that's out the window now. It now looks like the Feds are going to drop the rates twice, maybe once by the end of the year, because the economy is just holding on, okay? Now, because of that, mortgage rates are going to stay high. People borrowing money is going to stay high. All kinds of stuff is going to stay high. That's sustainable for this year. I don't think it's sustainable for next year. So reading some of the stuff that we're reading right now from some of the economists, what they're thinking is the longer that the Feds wait to drop rates, the less likely it is that we're going to have that soft landing. But if they take their foot off the gas right now, we're not going to have a soft landing. You're going to see things spike out. So I think we're at the point, we may be coming to the point where there's no soft landing. There's no such thing. And I think that's where we're headed. I think that that's what's going to happen. I think that what's going to happen is the economy is going to really slow down a lot. I think everything's going to finally hit at once. You're going to have a recession. Things are going to pull back. And I think that because of that, instead of the soft landing, if you have the soft landing, mortgage rates come down and they settle. I was thinking they're going to settle somewhere in the mid to upper fives. Now, what I'm thinking is you get into a recession, you get a whole bunch more people unemployed. Nationwide, you may lose 1 to 2 million jobs. The inflation goes in the other direction, consumer spending goes in the other direction, and the mortgage rates get really pulled back. Maybe they pull back into low fives. Could you get in the upper fours? I don't know. This is a long way off. That's the new thing that everybody's thinking is like that, because everybody's thinking the mortgage rates are going to get pulled back, but there's a floor. They're not going to get back to 3% unless something dramatically crazy happens. Like we're talking dramatically crazy, like coronavirus, right? So if something dramatically crazy happens, mortgage rates gets in the threes. I think it's going to be a while before we see that. I think the settled spot where everything is like, it's going to be somewhere like, I was thinking like 5.5 to 6.25. And the rates were going to meander in that spot when the economy was kind of balanced. But because the economy is rolling right now, they can't bring the rates down. Everything's going to stay super hot longer than they expected. I think we're going to miss the soft landing. I think it's going to end up being in a recession at some point, because at some point everything's going to crack. Everything's going to break, which is bad news for people. You don't want people to be out of work and everything, but when we talk about mortgage rates, you want to see mortgage rates get back in the 4s to 5s. That's a possibility. So now looking long term, that's what I'm thinking. I'm thinking more pain now means better mortgage rates down the road. That's my personal thought looking at everything. So when's that going to happen? Probably not going to happen until next year. Looking forward, what do I think is going to happen? And again, the thing to keep in mind too is this is an election year. All bets are off in an election year. Okay. But in a perfect world, looking at everything, what's going to happen, I think that as we head over the next, we're in April, 8 months to go, 7.5 months ago, you're going to see rates right now are in the low to mid 7s. I think they're going to hold in the upper 6s at best through probably the end of summer. Maybe they get in the mid 6s by the end of the year. Maybe. I don't think there's any chance we're going to be in the upper 5s by the end of the year unless something dramatic happens. Okay. Then next year, I think that the pain of not having enough drops finally catches up with the economy. I think that you have a breaking point. I think that you have an acceleration sometime next year where the rates really start to drop mortgage-wise. Okay. So is that totally bad news for homeowners? Probably not. Recessions are not, like lifelong events. They are, 6 month to 12-month events. And and I had economists talk about this on a podcast I was listening to. If you get a recession, you have 1 to 2 million people lose their home, or lose their jobs rather. Okay, which is terrible. You don't want anybody losing their jobs. 1 to 2 million people are going to lose their jobs. But in the average recession, mortgage rates drop about 1%. Every percent that the mortgage rates drop, 5 million buyers jump back into the pool. So even though 1 to 2 million people are going to lose their jobs, 5 million people are going to be jumping in looking for a house in the middle of a recession. Okay, so that's the thing to keep in mind about real estate too. So what does that mean? For you, if you're buying, so let's put a bow on all this. Going forward, what should you do? I am a real estate agent, so I will always say, always think, always believe, 99.9 times out of 100, that real estate is a great investment. Real estate is going to go up in value over time. Should you buy a house today to sell the house next week and hope to make money? No, that's a bad financial thing. You're talking about Bitcoin, or you're talking about buying stocks or something like that. You're talking about real estate. Real estate takes time, but over time, it's as solid of an investment as there is, period. Okay, so I will never tell you that it's a bad time to buy real estate. Okay, especially here in Atlanta. There are lots of crazy real estate markets. San Diego's crazy. Austin, Texas is crazy. Other parts of California are crazy. Sometimes the Northeast can be crazy. And when I say crazy, what I mean is they're much more volatile. You're going to get drops. And you're going to get big spikes and drops and big spikes. Here in Atlanta, we just have this kind of like the cable car Stone Mountain. We're going up nice and slow, going up the mountain. Okay, so that's what we do here. If you buy a house now, it's going to go up in value. Okay, if you wait to buy a house and you go to buy it next year, it's going to be more expensive. So that being said, the best play, in my opinion, if you're looking to drop roots somewhere and buy a house from a financial standpoint, what makes the most sense, buy today. Don't overdo it, because there's no guarantees on what the mortgage rates are going to do. So don't overdo the rates. Don't overdo it by $500 a month, hoping that the rates are going to come down. You'll refinance down the road. There's no guarantees, okay? Buy what you can afford, but buy the house now. Then, if and when the rates go down, you can refinance, okay? I'm not going to say the thing that everybody else says, because it drives me crazy. Okay, I'm not saying that, all right? Get somebody else to say that. But what I am going to say is real estate is a very good investment, in my opinion, here in Atlanta. You have to buy smart. Don't buy a dumb house. Don't buy a bad house. Don't be, whatever. Buy the right house. It's a great investment, okay? As the mortgage rates go down, which I think they're going to do, then you can refinance, okay? Here's the thing. If you wait a year until mortgage rates start to really do that drop, what if they get in the mid-fives? Think about the buyer traffic right now. Right now, buyer traffic's good. It's not crazy, but it's good. And we're sitting at 7.25 to 7.5 right now on mortgage rates. What do you think the buyer traffic's going to do when we get to 5.5? Who are you going to be competing with? You're going to be competing with everybody. Everybody's coming back when it gets to 5.5. So that house that right now, let's say, is 400, next year it's going to go up 5 to 7% every year. Let's just say 6. So 406, that's 20. So let's say it's 425. Then you're going to have 20 offers on every house. That 425 all of a sudden becomes 440 or 450. All right, so you buy for 450. So maybe the house is a little, what's the mortgage rate, or what's the payment, I should say, on something that you bought for 450 at 5.5 versus 400 right now at 7 point whatever. I don't know. I haven't done that math yet. But think about this, because I can guarantee you what's cheaper. You buy the house for 400 right now. You swallow the bad mortgage rate. Then, in a year, if it gets to 5.5, you refi the $400,000 house instead of buying the $450,000 house. You've saved yourself a boatload of money. Mortgage rate's going to be, or your mortgage payment, I should say, is going to be much lower if you do it that way. Okay. The real estate landscape is littered with people who look, and I'm one of them, that look and say, if I just bought that house 5 years ago, okay, there's always the guy, the market's going to crash guy. Because we had the big market crash of 06 and 07, the market's going to crash. Doesn't happen in real estate. That was a once in a lifetime situation, and every reason why it happened has been alleviated. Okay, for many reasons, and we've talked about them a lot in these videos. Okay, it's not going to happen anytime soon. So we'll say for at least the next 3 to 5 years, the prices aren't going down in Atlanta. Okay, so call me crazy. All right, maybe I'm wrong, but real estate is a safe bet. Buy it, hold it, it goes up in value. You find all kinds of people who say, I wish I had bought something 5 years ago. Okay, prices are going up. Think about the future. Think about what makes the most sense. And that's something we talk about. So this is where I'm going to end it. All right. Again, like, subscribe, love me, mean it, never change. If you want to talk about what makes sense for you, because everybody's different, everybody's economy is different. If you don't have the money to put down, if you're thinking about, I only have I don't even have 3% to put down on an FHA loan, or 3.5%, and I can barely make my bills right now, please don't buy a house. Okay? Don't do that. If it doesn't make financial sense for you, please, it doesn't make financial sense for you. But if you're sitting on money saying, this is the time to buy, I just don't think it's the time to buy. I mean, I'm ready. I just don't think it's the right time. You're wrong. Okay, this is it. Let's jump. Let's figure it out. But again, everybody's different. Call me and let's talk about what makes the most sense. Because I've talked to plenty of people. I talk to people and say, pack your crap, we're going right now. I talk to plenty of people and say, you know what? Here's the plan. I just got an email from somebody who I used to work with at the TV station. Okay, her and her family, they've been looking to move for years. Okay, and they've been looking and they've been trying to work out payment and trying to work out how can they get money out of their 401k to do down payment. This doesn't work, that doesn't work, whatever. And I told her, I said, look, it doesn't work right now. It's okay. You don't have to apologize. It's been years we've been talking about it. And I told her, when it's time, it's time. And we'll all know it's time. Okay, everybody's different. Okay, but if you've got all your ducks in a row, if you've got the money and it's time to make the move, let's go. I'll pick you up. We'll go grab some coffee, some Starbucks on the way. Let's go buy a house. Okay, that's my thought process. So, interest rates stink, but there's hope at the end of the tunnel because I think because they stink so much worse now than we thought they were going to be, I think there's going to be even better spot for mortgage rates down the road than what we were expecting. We just have to get there. I don't know what's going to happen. So we're going to watch together. Call me, 470-233-4409. The email is down below. And this is Steve, EXP, Atlanta area. I appreciate y'all. Take care. Bye.